let's say you had $20 to invest, right? You're not putting all $20 into one company. You're putting $1 into 20 different companies. Obviously, that's a very small amount. I'm just using that as a very, very simple example. But coming in with the mindset that if you are going to be an angel investor and if you are going to have the greatest chance of success, that you should expect to carry 20 different portfolio companies. That should be your goal. How to become a confident angel investor. In this section, we'll be talking about how much money you should actually be allocating to your startup investment portfolio. How many deals should you be thinking about as you consider how much money you should put into each of the deals? The importance of diversification within your startup portfolio. Which industries you should be considering for yourself, which will be different from each of the different people. And then how to develop your investment thesis. First thing to cover, and this is one of the first questions that I get from people when they think about how do I get started? How much money should you actually allocate into this? The first question I like to think about for you is, what is your risk profile? At the end of the day, you should only invest what you are willing to lose. And so there's two ways to always look at this. One is, what is the best case scenario for my investments? And this goes back to your goals, right? Is your goal to double the amount within a certain period of time? Is your goal to make a little bit more than you would otherwise? Is your goal to learn while not going negative? And then what is the worst case scenario for my investments? The one thing that I really love about this is the worst case scenario for your investments is to lose 1x what you put in, right? If you put in 10,000 and everything doesn't work, you lose 10,000. You don't lose 20,000. You don't lose 50,000. If you put in 100, the most you can lose is $100. So really the first thing to ask yourself is, what kind of disposable income do I have, and what am I willing to lose when it comes to these investments? And as you're thinking about that, just make sure to balance that with ambitious goals around how much you could gain if you made even a few successful startup investments. And we'll go through this a little bit more, but this is something that I always just say for yourself in your journals, in your notepads, just write this down. Like, what is the best case scenario for my investments? What's the worst case scenario for my investments? And thinking about that. And so when it comes to the actual amount, again, don't put your entire life savings into risky investments. I like to use the 10% rule of thumb. This is what all professional angel investors do. So we recommend, if you're new, that you do something between 5 to 10% rule of thumb. And so what we do is, when you're actually looking at your investment portfolio, the amount of money that you are setting aside for all of your investments, that 10% of your portfolio should go into high growth startup investments, whereas that other 90%, maybe you'd like to start with putting that 90% into index funds. Maybe you'd like to allocate some of that into stocks that you'd like to pick, bonds that you'd like to put in. Personally, I put a significant amount into robo-advisors, the Betterments, the Wealthfronts of the world, because I'm spending my time really looking at the highest potential private startup investments within my 10%. And that means I don't have time to be constantly looking at the stock market, looking at what's up, what's down. And so given the way the robo-advisors are working, I put a lot of that money just into the automatic investments via index funds. And again, the reason I do this is because angel investing provides an unlimited upside, the potential for exponential gains. And just as another example, you could put in $100 and make over $800,000, and that's what early Apple investors were able to make. That's the type of gains when Apple was early on. Or, if your investment increases by just 2.5x, you could make $250 from that. But these are the types of gains that you can make when you put a little bit in, whether it's 10x or 100x or just 2.5x. When it comes to individual angel investors, a really good return already, just 2x is a really, really good return. It's those unicorn ballparks that take us to the 100x, the 10x's. And really all you need is one to return your entire portfolio. But the average angel investor, a 2x, a 2.5x is a really, really good return. Now, when it comes to how do you maximize this potential for the ones that you are going to, that you're going to hit a home run. And so here's how we think about it. Within the 10% that you invest, you have to diversify heavily. And that means, the way that I talked about it is you spread it out across different industries, different business models, different stages. And what you have an advantage in as an individual angel investor versus a venture capitalist is that you can actually diversify across 20 plus companies, while most venture capitalists actually do only 1 to 2 major deals a year. They might do some small ones here and there, but especially the micro funds, they don't have a significant advantage over the individual angel investor. So what that looks like is, whereas most people think they get really excited when they see one angel investment or one startup that their friend of a friend, their brother told them about, and they said, this is a really good deal. The best angel investors are spreading their startup investments across at least 20 different portfolio companies over time. So that means if you have, a certain amount of money, to make it super easy, let's say you had $20 to invest, right? You're not putting all $20 into one company. You're putting $1 into 20 different companies. Obviously, that's a very small amount. I'm just using that as a very, very simple example. But coming in with the mindset that if you are going to be an angel investor and if you are going to have the greatest chance of success, that you should expect to carry 20 different portfolio companies. That should be your goal. So when you have that goal, you take a look at what the amount is, your 10%. What's that amount for you? Maybe that's $1,000, maybe that's $5,000. But then you divide that amount by 20, and then you get the amount that you should invest in each company. Regardless of how much you love the company, be able to weight it accordingly. When it comes to which industries to focus on, I always say that you should start with what you know. This is what all investors talk about. And there's really 2 types of professional venture capitalists, and they kind of take 2 different routes. One is they start as industry experts. So they have a specific niche that they're focusing on. And they say, I'm going to become an expert in, say, cannabis, or I'm going to become an expert in digital health. And they focus all of their time and energy examining the trends there, seeing what kinds of companies are coming in, what kinds of competitors. And the other kind of investor says, I'm going to be a generalist, and I'm just going to put a little bit of money in AI. I'm going to put a little bit of money in real estate. I'll put a little bit of money in sustainability. And then as they figure out which ones they're most interested, they zoom into one industry. If you are new to angel investing, you should always start with what you know, because this isn't your full-time job, right? You don't have time to get to know all of these different industries right off the bat. And the way you start with what you know is you really ask yourself, what is your experience in life? If you work in real estate, then look at real estate tech companies. Look at things that you're curious about within real estate tech. The advantage you have here is that you have connections, you've been in that industry, and you kind of know and understand the trends and the history about that particular industry. And then later on, you can always branch out and you could say, well, if I could pick an MBA topic, what would it be? What would I be really, really curious about? And that's when you expand. So I always say, as an angel investor, start with your niche. And then later on, as you're growing that portfolio, follow your curiosity. So understanding your own expertise is the quickest path to finding your first great angel investment. And I like to take this example also for retail. So I was actually talking to a friend of mine who works in fashion, and she said, I don't know anything about finance. I've never invested before. And I said, well, you actually know a lot because you've worked in retail, you've worked in fashion all your life. And so we talked through some of these questions. Where do you think the future of fashion will be 10 years from now? Is it sustainable fabrics and dyes? Is it a more efficient supply chain? Are you familiar with the nature of the business and how it adapts to change? And all of these, she was able to answer really, really quickly because she's a designer. And so she was talking about how there's so much waste in the retail industry. There's so much synthetic dyes and fabrics, and that the future is and we're already seeing the shift in consumer demand for sustainable fabrics, for reusable fabrics, for clothes that are actually good for our environment. So this is just an example of someone who thought that they didn't have any real knowledge in finance, but was actually able to make her first startup investment in a sustainable fashion company because she felt really confident about the trends in the past, as well as creating an investment thesis about what's coming next in the future of retail. So as you think about developing your own investment thesis, the real thing here to remember is that the whole point of startup investing is that this is a long-term bet on what the future will bring. Unlike public stock market investments, things where you can track the ups and downs, you're basically betting on, a couple years down the line, or if you're an active investor, you're selling and you're trading actively. But startup investing is the longest term bet you can make. And it is an illiquid investment, meaning you're not going to see that money for a few years until the startup has a significant trigger event, which is an acquisition or an exit of some sort. And so as you think about the future, think about how you are going to factor in changing economic systems, technological advancements, human behavior. So some of these questions that are out of the box thinking that the best investors ask themselves are things like, are people still going to be using the iPhone years from now, or will there be something else? We see the advent of voice. So for example, I'm very bullish on the future of audio and voice and how that's going to affect the way that we communicate, the way that we create commands, the way that people lead. Questions like, will people still be watching Netflix 10 years from now? This didn't exist a decade ago, and yet this is such a pervasive part of our entire day-to-day societal culture. And so will there be different ways that people are consuming entertainment and media? These are the types of big picture macro questions that the best venture capitalists and angel investors are asking. Even things like cars. Will people still be driving cars 10 years from now? Or will they all be automated? Will there be a different way that we'll be fueling these cars? Where are we going to get the parts? Will they be recyclable and reusable, and who's going to come into that industry? These are the strategic and forward-thinking questions that will give you an undeniable edge in your investing journey. So be open and really thinking optimistically and strategically about the future, but to start with your very first investment, find your niche and really dive into that and understand the trends. Ask yourself the hard questions. What you're really finding out here, and even the way that I'm talking about it, is that this is an intellectual exercise. The best investors are the ones who are curious, who really, really are excited about thinking about the future, not just being stuck in the present. What happens with most people is that we watch the news and we are pulled back and forth by whatever the news is telling us, whatever's happening in the present, whatever's happening in the past. But very few people step out of that echo chamber and say, I'm going to really ask these critical questions about the future. And that's where your edge as an angel investor is going to come in. So in the Confident Investor Playbook, I go more into these, but these are just some of the upcoming industries that I am really excited about: sustainability, health tech, cannabis, cybersecurity, AI, and much, much more. But I see a lot of these as the fundamental drivers of the way our systems are going to change. Another thing that I think will be really interesting to keep an eye on is government tech. As we all know, there's so many inefficiencies with our government today. And when we talk about in the startup space, how people are looking at government tech, how people will lead in the future. That's where we're looking for as angel investors. Like, where are the inefficiencies? Where are the inefficiencies, and how can new sorts of technology, scalable technology, really plug in to think about where we're going to be in the future and how that's going to create a better world for everyone. As mentioned, just a high level summary. The most important traits to cultivate as an angel investor investing in high growth startups are things like patience. Again, this is a long-term game that requires long-term thinking. You are not going to exit anytime before 5 years when you put your money in. And that's why you take this mindset of going on a journey. If you're looking for a get rich quick scheme, this is not going to be it. But if you're looking to learn and grow and really cultivate the patience of what it takes to be a great investor, startup investing is great for you. Focus is also something that is so important. And this goes back to, understanding your niche, understanding how you are going to ask critical questions, and being around people who are also within that niche. So you really get the insider's edge around, what are some of the new companies that are coming out within the specific focus you're in. And then, of course, optimism. I think this is the key thing for all startup entrepreneurs, for startup investors. Again, this question goes back to, what if things go right, rather than what if things go wrong? And then you guys have probably heard about this growth mindset. Growth mindset means even if you lose money, even if things don't go right, at the end of the day, that's how you grow as an investor. You learn from the mistakes that you made, you learn from the losses, and you don't take that as a marker of your value or your self-worth or your investing capability. This is just as much about luck as it is about careful research. That is what investing is. But the more you play, the more you go in with these best practices of diversification, of using the 10% rule, understanding the various asset classes and finding your niche. That's really where you're going to hit some of those big home runs. Final note for this section is simply invest in what you feel comfortable with to start. Figure out what that niche is. Remember that this is a learning process, and always take a long-term view when it comes to starting this journey.